the market's going up and down and moving around, if you have no idea, how that works over history, why the market's going up and down, expect
Right.
on normal market conditions, yeah, your money going up and down is disconcerting. But if you have a little bit of knowledge, all of a sudden that fear, that stress, that lack of understanding is
Yes.
gone. At least very minimized.
How do business people or people in general set themselves up for a better financial future?
Yeah. I mean,
That's a loaded question.
That's a very open question. And I mean, I guess the easiest way to address it is there's no answer.
Yeah.
Right? Like there's a myriad of ways you can improve your financial situation.
Sure.
And I would say the key is to do something.
Yeah.
Find something the value of your money can grow into over time, and know your numbers.
Like that, know your numbers.
Like
what does that mean?
It's pretty simple math, right? Like it doesn't take a math whiz to say if I have this much money growing at an average of this % for this amount of time. It's a pretty simple calculation.
Well, I think you think it's simple.
Well, just get an app, go online, look up this free calculator. You plug in a few variables.
I think there's a lot of people that don't know though. Like, I was one of those people when we first talked.
Oh, 100%, right? And that's why I think a lot of people, like step one is complete for a lot of people. They're doing something.
Yeah.
Whether or not they're very knowledgeable in what that is or what their numbers are, that's kind of the question mark.
Right.
Right? Like, I'm saving.
In an RSP or something.
Yeah.
Right.
And even that for some people is a step too far.
Really?
I go, what type of account are you saving? And they go,
savings account.
Something that I said, is the bank set up for me? And I go, okay. And is it invested in any way? And they go, I don't know. And I go, so how are you supposed to be aware if you're anywhere near on track for the goals you want to reach? And they go, I don't know. Like, okay, well, that and that's why I say
it's funny. It's funny and it's not funny.
It's not like you'd think it's so simple, but like where are you taught that?
Nowhere.
Yeah. So like
nowhere. Like
yeah, I mean and it has such a negative connotation to say, but it's a financial literacy problem. And that's not like, to be illiterate, people don't want to be called illiterate. But like, no. I put it in this context. Like, you speak Spanish.
Yes.
I'm completely illiterate in Spanish.
Sure.
Does that mean I'm dumb?
No.
No, I've just never taken the time to learn, and no one's ever taught me.
Yes.
Right?
But that's a school thing.
Yeah, I wish.
No, but it's true, right? Like, the fact that there isn't a class or whatever in high school.
Yeah.
To
the
teach you the principles. The principles.
Just and that's what I
like. It's not. It's not a financial plug. It's like, just teach the if you can just teach the principles.
Yes.
Of even like the
just how does compounding
effect?
Yeah. How does compound interest work?
Yeah.
And that's again like a 5-minute. Here's how to use this calculator.
Right.
It has 4 variables. You just plug in your what am I starting with?
Yep.
What am I putting away monthly or annually?
Yep.
What is my rate of return?
Yep.
And you can look up your fund and look at the long-term rate of return. And then how long do I have? And you just plug in those 4 and you can play with the numbers and it'll spit out, this is how much money you'll end up with.
You know,
it's not complicated.
No, it's not. But it kind of pisses me off.
Why?
It does. It pisses me off. Like after having a conversation with you about it and remembering high school and that not being a part of it, it actually pisses me off.
Like, honestly, that's what drove me into this.
Yeah.
Is I got to the point, I was 27.
Yeah.
And you go through school.
Yep.
And what you're taught is, get your high school.
Yep.
Go get a degree.
Yep.
And then get a good job, buy a house, have a family.
Yep.
That's life.
That's
the circle of
the circle of life.
And we had our first kid. We owned a home. and we were renting out the basement, and I had a university degree and I had a job in that field, and my wife had the same, and we were 27, and I went,
Now
now what?
Yeah.
Like, do I just sit here for the next 38 years till I'm 65 and
Yep.
is that it?
Yep.
And two, like, I had no idea what to set up for the next 38 years. Like, that was all I was taught to set up, and that's not really a hard list to accomplish. And then blank.
Yeah.
Someone tells you what to do till you're 25.
Yeah.
And then what?
Yeah.
And that's kind of where I got to, and then that's kind of what led me into digging in and like you, learning a lot about this, and I went, this is egregious that we are not taught at least the basics of this.
I'm telling you, I know.
And so I like, that's where I looked at it, and I said, I think with like any entrepreneurial adventure, you look at, there's a need somewhere.
Yeah.
I have a passion for it.
Yeah.
I would like to provide the service to fill that need.
Yep.
And that's where I got to with finances, saying, how many other 27 to 35-year-old people and up to 80-year-olds are in the same boat where there's just a lot of questions.
Well, I actually just thought about it the other day before you came. Speaking to a few mortgage people recently, the cost of buying a home.
Yeah.
The possible unlikelihood of a lot of people not being able to
renew mortgages
or buy one in the first place.
Yeah.
Just too far out. That's why I say, like, I think financial literacy in school, at least at some point in that high school journey, to help educate someone on at least that part of saving and investing, if for anything, to be able to get the down payment to buy a home.
Yeah, and I mean,
so that when they are at least even like 25 to 27, they can actually get into a home, or teaching parents, if they do have a little bit of something extra, just something they can do to a lot of people to set them up for that big ticket purchase or whatever. Like, it's a significant investment. So
it is. And like, I mean, you speak to houses, but you can speak to groceries and fuel and cars, and like, it's not, the numbers are not getting easier for young people.
No.
So the literacy and I want to say, like, the attention to your finances is getting more and more important.
Yeah.
Because there's not as much free money around, and it does require, mathematically, you can't, the numbers don't lie, it requires more discipline.
There's something they can do
now than it did 30 years ago.
Yeah.
Not to say, like, you can take two routes with that, right? You can play the victim and go, oh, things are tougher.
Yes.
And then you can sit on your couch and, oh, it's just hard to buy a house, so I'll live in my parents' basement.
Yes.
Or you can take some steps towards, like, well, what can I control? What factors can I control to make sure I can move myself forward?
Yeah.
Regardless of what the uncontrollables are.
No, and I wasn't going for like the victim mentality component.
No, but yeah, it does stress the importance of.
Yeah, just like you said, the discipline, I think is a good word, right? Like the discipline of doing something, and that if you are at least a little disciplined and can make the right type of investment or financial decisions, that it's going to be easier than not.
Yeah, and I always...
It's going to be easier than just, like you say, sitting on the couch enjoying your bag of Doritos and a pop.
It probably isn't going to be easier this month.
No.
But it sure will be easier later on and as you go through life to start taking those steps. And I'm pretty careful even with terms like what's the right investment.
Sure.
Because, like I said, you can invest in real estate, you can invest in land, you can invest in your business, you can invest in the stock market.
Oh, totally.
Right? Like, and that's why I say, like, just do something you're comfortable with. For a lot of people, that is just investing in the stock market. It's hands off.
Yep.
I can go to my day job, my money can grow.
Yep.
It's very simple. Someone like you had Justin on, heavily into real estate.
Yep.
He knows what he's doing there. And we talk Noah's numbers.
Yep.
knows his numbers.
Yeah, knows his
Right?
numbers.
And so he's done very well there.
Yep.
That's why there's no right,
No,
but there's some right fundamentals.
I just, yeah,
Right.
and what stuck out to me, I don't know, maybe you can explain it in like
We'll see.
No, I know you can. I still think that there's a lot of people that really don't understand compound interest.
Yes.
Like their exposure to compound interest is their credit card.
Yeah, it's negative
Yeah,
compounding.
exactly.
It's that, but the other way.
It's
is
like,
what
here,
we
make
want.
your minimum payment, and that just added.
You owe us $500 more.
Yes.
Yeah.
And I remember watching. I had a little bit of I guess work experience in the financial world, and I remember like starting to actually pay attention and seeing like where it would show someone's minimum payment on a credit card, and if they made that minimum payment, how long it would take.
Oh yeah, like
before
hundreds of
and
years.
yeah, and it was like, someone might only owe like a few $1,000, and it was like, this will take you like 47 years to pay off, and I'm like,
And you end up paying
What?
$110,000 overall for the $2,000 purchase.
so
Yeah.
so I guess where I'm going with it is, I'm hoping that maybe you can shed light, especially even on like, let's call it the 18-year-old, if you will, or just starting there, let's call
Yeah.
it there, like to just kind of explain like how something can start to really compound, and maybe if we can use like a specific number, just to give people the idea or the sense of like, if you put,
Yeah.
if you were to put this much away, and you did this, like what is roughly what they might have at 65. Again, it's just to give an idea
Yeah.
of what, because I don't think a lot of people really wholeheartedly understand how
big it can.
yeah, how it grows.
And the easiest way that we use to explain the compounding effect is
Yep.
the rule of 72.
Okay.
Okay, so the rule of 72 tells you how long it would take for your money to double
Okay.
based on your interest rate you're earning.
Okay.
So you take your interest rate, let's say 10% for very
Sure.
easy math.
Yep, yep.
You divide it into 72. So
Okay.
that's 7.2.
Yep.
That means your money will double every 7.2 years.
Right.
Okay, so when we are talking investments, a lot of times we talk about how many doubling periods do you have left?
There. Yes.
And that's a simple way to look at it. So like if I'm getting a 3% rate of return, well, 3 into 72 is 24. So
Yeah.
that means my money doubles twice. If I'm 18, over 48 years,
Yeah.
my money will double twice.
Yeah. By the time I hit
So you'll be
essentially retirement.
66. Yeah. And so if you put $10,000 in when you're 18, in 24 years it'll be 20,
Yeah.
and in 48 years it'll be 40.
Yeah.
Well, great, ready to retire, 40 grand.
Yeah.
Right? Where if you look at the number we use is 12%, which like
Yeah.
not a projection or
Yeah,
anything,
yeah.
just for math. 12% into 72 is 6.
Right.
And if your money doubles every 6 years, the same 10,000 over 48 years,
Yeah.
now it's going to double 8 times. 6 times 8,
Yeah.
48.
Yeah.
And it comes out to be just over 2.5 million
Yeah. And see
versus
that
40,000.
that's the crazy part.
And I mean, the numbers are just for easy math.
Yeah, yeah.
Thinking what divides into 72.
Yeah. Yeah.
But knowing the difference, and as I say, know your numbers. Okay, well, what am I getting?
Yeah.
And then even without a calculator, you can use the rule of 72.
Yes.
I've got 20 years to retirement. My money's going to double every 10 years. Okay, well, it'll double twice.
Yep.
And approximately I'll get here.
Yep.
Is
And-
that
and
is that enough or?
No, but I really appreciated the explanation, because that I don't think, especially from like young people, I feel like, well, I mean, you probably went through it a little bit. Obviously, you were saying like you're 27 and what are you doing next?
Yeah.
But I mean, like, I don't think people really get taught that early enough to understand like how beneficial and how much that can compound.
Right, yeah.
If you're in the right mix of, I get that it depends on the right mix of investments and like there there are components to that. I don't want to get into like the itty
No,
bitty of
we don't
everything,
need to
but
get into that. But just a basic understanding of the difference that can make over time.
yeah.
Right? And if you're saving for a short-term goal, maybe that 3% very safe fund is perfect
Yeah.
for the next couple of years.
Yeah.
But when we're 18-year-olds saving for 45 years, well, whether you choose which path you choose or not, at least understand what the numbers are.
Yeah.
So you can make an informed decision, right? Where a lot of people, in my boat, I was saving through an old group RRSP at work.
Yep.
And I had gone and set it up at a financial institution that was through my work.
Yep.
I had no idea what I was doing at the time, and they asked, well, what's your risk tolerance? I go, I don't know, low, I guess. Like, I don't want to lose my money. I don't know anything about this. And after learning some more, I looked at the fund, and it was just over 3% long term. Okay, so with what I was putting in and what time I had left,
Yep.
I did the numbers, and I would have had about $330,000 for retirement.
Okay.
If you think about inflation over the next, I'm 30, so 35 years, that's not going to be very much money.
No.
I looked at, well, what about some different funds, even the ones offered there? Well, they had funds offering much higher return, obviously more volatility, but understanding over that time period, I can ride that out after learning a bit. And if I just got into, a growth fund there that's designed for long term, even at the same institution, the same budget over the same time would have yielded, at that rate of return is just under 9 for that specific growth fund, would have yielded about 1.65 million instead of 330,000.
Wow.
So that's where I say, like, do something.
So what's that, like five times?
5 times.
Yeah.
Right about 5. But do something, which is good. That's where I was at. Do something.
Yeah.
And then know your numbers.
Yeah.
And it does not rocket science to just kind of run some simple calculations, whether you use the rule of 72 for a rough idea or just Google a calculator.
Do you feel that like people, and I'm not saying everybody obviously, but like, are people afraid to get into the market or like to invest? Are they, or again, because I'm the dumb guy in the room, like are they afraid to invest, or are they looking for, I don't know how else to say this, or do people just like think that they got to find like the unicorn? I don't know if I'm wording that right.
I understand what you're asking, and again, I think it's an education issue.
Yeah.
So here's how I put this.
Yeah.
If someone asked me, I would like you to build me a website and do my digital marketing for the next 6 months and run me a report, what my clicks are getting, what they're leading to, what my profit per click is.
Okay.
That would make me remarkably nervous. I have no idea how to do that.
Right.
Does that make you nervous when someone asks you that?
No.
Because you know what you're doing.
Because I know it, yeah.
So you just have more knowledge than I do. The task is the same, right? And it's the same when it comes to the market, right? Like the market's going up and down and moving around. If you have no idea, how that works over history, why that's happening, what to expect on normal market conditions, your money going up and down is disconcerting. But if you have a little bit of knowledge, all of a sudden that fear, that stress, that lack of understanding is gone. At least very minimized.
So, but if I'm hearing you, then that is technically then an issue. It's like they're scared because if there's any market volatility, they're like, oh, I'm going to lose my money. Almost like, I know this isn't the word I was trying to go for, but where I was trying to think of is like, do people assimilate investing like just with the way of the internet and with the information that's out there, like day trading basically? Yeah. Like that's what I meant by unicorn. Like, are they expecting, hey, like if I can put like $1,000 into this and I'm going to throw it into GameStop and time it perfectly, like I'm going to make $100,000 or whatever on my $1,000 investment.
They go like, oh, if I screw up the timing, I lose it all.
Yeah.
That is not. I mean, there is that side of investing, but like that is not the professional market. Right. That's not what any financial institution does.
Right.
Like, so when we think about, can I lose all my money? Well, you talk about a typical growth fund
Yeah.
in today's market. Even look a year back, and it was even simpler.
Yeah.
In the U.S., it was called the Magnificent Seven. It was the big seven tech companies that were running the market.
Yep.
Okay, so if you own all seven in a growth fund, which a lot of growth funds in Canada owned all seven, because they were really the only ones moving the market at the time, or at least they owned like 5 of the 7.
Yeah.
Well, what are the chances Apple, Nvidia, Tesla, Alphabet go broke at the same time?
Yeah, like
that's the only way you would lose all your money.
yeah, the chances of that happening.
Will their price fluctuate?
Yeah.
Absolutely. But the risk of you losing all your money, it doesn't exist. Like the whole global economy needs to collapse.
Yeah, I feel like if one of them went broke, another tech company would just replace them anyway.
Yeah, and then
it would just be a shift of like, well, let's move this company into this fund and
and in pretty well any investing scenario, you have an advisor and you have a fund manager at whatever company you're using.
Yeah.
That fund manager is watching the markets
Yeah.
from open to close, and most of them globally.
Yeah.
So 24 hours a day somewhere, every day.
Yeah.
So like if Apple starts dropping and there's a problem, well, a lot of them will have a sell on it.
Yep.
Right? If it gets to this price, auto sell.
Yep.
Or at least I'm watching it and I can. So it's not just like Apple's going to drop 50% and the guy's going to sit there twiddling his thumbs.
Yeah, being like, oh,
this is fine. Right? Like that's his job and they're very good at what they do.
Yeah.
Right? So.
And just understanding the complexities of why it's happening.
Right. And even just like on a macro scale.
Yeah. Yeah.
Like you don't need to understand, you don't need to watch Apple's earnings report and that's his job.
Yeah.
Great. But like you do need to understand what simple sort of things cause markets to go up and down.
Okay.
Which is that's not complicated. You just look at, the interest rate situation.
Sure.
And you look at, are we printing money? And there's obviously things that affected, like not really anyone predicts COVID. And that causes some market changes. But understanding, like for the global markets to go down for a long period of time, it can't really happen sustainably.
Right.
Because that means large companies all around the world are all losing money.
Right.
Well,
all at the same time.
All at the same time.
Yeah.
Like something's going to happen in the free market world where either a new company is going to take in or that company is going to change what they're doing a bit and they're going to start making profit again. And
like toilet paper in COVID.
And there's things like that.
Like had you owned shares in Charmin.
Exactly. And like that's a good point because like at the basics of it, what it boils down to is just supply and demand.
Yeah. Yeah.
Right? Like the tech companies were huge during COVID. Why? Everyone went home and we needed more technical support.
Yep.
People were buying laptops. We needed Zoom. We needed.
Yep.
It's just supply and demand. And it's not arbitrary why those companies raised in value.
Yep.
Right? So when you think of it that way, kind of back to the base question, just a little bit of that understanding, and would that take us 5 minutes to go over some basics?
Yeah.
And all of like the fear with the markets can be lessened quite a bit.
Okay.
Especially with with a long-term mindset.
So again, and I'm just trying to ask stuff the way that I feel like
that you did a couple weeks ago.
Yeah, well, just like every like just again, ignorance is bliss.
Yeah. Yeah.
Okay, but now so you're talking about fund managers. You're talking about having essentially a financial representative that maybe at a local area that's helping you plan and look towards your long-term goals. I guess like maybe trust isn't the right word.
Yeah.
But I was gonna say like how or I'm really trying to think of how to ask you the question. Like, I guess let's say app versus financial representative.
Yeah.
Like, obviously in today's world we've got technology.
Yeah.
I would say maybe uninformed technology, but nevertheless technology.
Yeah.
That like with a click of a button, you can buy XYJ stock or whatever. Why do you, like just from? I know you're in the industry, obviously, but like, why is it maybe important for someone to come to someone like you, I guess versus, I guess the plethora of like the
Yeah.
options that are on the table.
And
And not to put you in the hot seat on
it
that.
really depends like where you're at
Yep.
knowledge wise and right, like if you have a very good understanding and obviously like be honest with yourself.
Yeah.
Everyone likes to think they're a money guru. But like if you actually have a good understanding of what you're doing
Yeah.
and you don't need an advisor to help you plan and big one there and hold you accountable
Right.
is a big one for advisors. Then yeah, great. Well, simple Questrade have some reasonable options on there.
Yeah.
The back end of that is the money management side,
Right.
right? Where a lot of the apps is algorithm based.
Yeah.
So you have whatever your opinion is. Like some of the algorithms do a fine job.
Yeah.
My personal opinion is I would like a human being
Yeah.
who knows the companies, who checks earnings reports, who has talked to the people in the company, and they make decisions for me.
Yeah.
Right, and that's where you get like the online apps
Yep.
are big advertising right now, low fees, way lower fees.
Okay.
Correct. Because you aren't paying for an advisor, you're doing
Yeah.
that yourself,
Yeah.
and you're not paying for a money manager because you're doing that yourself or there's an algorithm helping you, and algorithms are a lot cheaper than humans.
Well,
Right.
I feel like that might end up being the opposite end of that, but
Yeah.
I get where you're going. Continue.
Right? But I mean, that's the differences, right? So if you want someone to sit down, help you plan, help you educate, and stick with you, keep you accountable, and you want to
monitor.
monitor, like, are you on track? Do we
Yeah.
need to change things?
Yeah.
Which generally over a long time, you're not changing very often,
No.
right? But life changes where all of a sudden you have a kid and now, well, what do we do? What if we want to save for their education or, right? Things don't stay stagnant. But yeah, that's,
Yeah.
and
So
I
you're
like,
you're like a dumb example, but basically like having a gym coach, really. Like,
yeah, fitness in our industry goes, can
yeah.
you go to the gym and work out by yourself?
sure.
Totally.
Yeah.
Are you someone who's going to stay disciplined and know what you're doing and get good results?
And there's some people that will.
Good for
Right.
them. Awesome.
But the vast majority.
Need someone to whip their butt a bit
Yeah.
and keep them disciplined and maybe show them
Yeah.
some exercises.
Build some workout
and-
plans, right?
Yeah.
Yeah.
It's the exact same
Yeah.
idea. Do you have to pay more to get a trainer?
Yes.
Yes.
Yeah.
And then it's up to you. Am I in a position where I don't need to pay those fees and I can get good enough results on my own? Or
Do you think though that people think like, okay, using the fitness as an example, like if I go to a gym and I have to pay a fitness trainer to help me, I'm obviously paying them, let's say up front, right?
Sure.
Okay, it's going to cost me whatever the number is
Yeah.
up front. So that works differently though in the financial world a bit, does it not?
a bit, yeah. Like your fees in the financial are always a percentage of the money you have,
Right.
right? So, yeah.
But, so you're not technically paying up front though, is what I'm saying. Like if someone was scared of being like, do I have to have...
No, it's usually monthly with most of it,
Yeah.
where a percentage of what you have in that account
Yeah.
is taken out
Yeah.
monthly, and it pays me as the advisor.
Yeah.
It pays
The fund manager.
the fund manager,
Yeah.
and that's how it's taken. And really, like the talk about fees, it's important to understand like why fees are different.
Yep.
And why Questrade has really low fees and active money management has higher fees.
Yep.
But the important part is, what do you take home?
Right.
Right? Like, because example I use Levi, if I told you like I guarantee you a 30% rate of return, would you take it?
I mean, yeah.
Yeah. Well, what if I told you that your investment's actually going to return 40 and I'm taking 10, but you get to keep 30? Still okay with that?
100 million%.
Yeah.
Yeah.
Right. So there's really the take home is the key, right? Like
Yeah.
if I'm in a fund that's returning 12% and I'm paying a 2% fee
Yeah.
to take home 10, or if I'm in a fund that's returning 6 and I'm paying a 0.5% fee to take home 5.5,
Yeah.
well, I'm still farther ahead,
Yeah.
getting a higher rate of
Yeah.
return. So that's kind of what you have to weigh.
Are there, and maybe it's more on like the banking side, if I understood correctly, but like, taking into consideration inflation and maybe like the lower investment vehicles that are more typical in like a standard banking institution that isn't necessarily guiding you. Maybe that's like, say, RSP or TFSA without any investment vehicles attached to those accounts. Like, is that where that could be problematic for someone? Like, in terms of not just like the end number, but I would assume at a bank they would be charging you fees.
Yes, it's the same thing at a bank, right? You go there, you can choose to invest it with whatever their investing branch is. Well, that's the same thing. You get an advisor sometimes, and then you are paying their money manager to manage the fund, right? Every bank has an investment branch, and they have money managers, and they manage funds. It's the same process as anything else. But yeah, I wouldn't say.
But like you're mentioning, like 3% potentially.
Well, and that's really
versus
and don't, like, a lot of people think of like a good versus a bad investment. Like, 3% is bad and 9% is good. Wrong. That fund is designed to return 3%. It's just really low risk. It's not going to go up and down very much, and most often it should be correlated with time. Like I said earlier, I'm saving to buy a house in the next 3 years. I don't want volatility. Right. Because if the market drops right before I need to take it out for my down payment, well, now I'm down X amount of dollars that I was supposed to have for my down payment. So maybe that 3%, it's not a lot of time, so there's not going to be a ton of growth either way. I'm looking for capital safety. And that 3% fund provides that.
That makes sense. That actually
if I'm
is a great
saving for retirement, and I'm not going to take the money out for 20, 30, 40 years, well, it doesn't really matter if the markets go up and down 5 years from now or 10 years from now.
Right.
I can handle some of that volatility because I have time.
Right.
And then, there's funds designed to return. There's quite a few, even at the banks, that can return 8, 9, 10%.
Gotcha.
They're going to go up and down a lot more.
Right.
Right. So the 9% one isn't a good one, and the 3% one isn't a bad one.
Yeah.
They're designed for two totally different things.
Right.
Then there's blends anywhere in between. Yeah,
that's where you can get into, like, I guess the word would be like diversification of your portfolio, if you will.
Right.
And
so on that note, like, what we always talk to people about is you should have 3 accounts.
Okay.
Right. You should have an emergency fund.
Yep.
You should have some sort of short-term savings fund, and sometimes multiple of these.
Yep.
You know, a vacation, a house, save for a new vehicle, and then a retirement fund. And the reason being is you're going to have different investment vehicles for your different goals because they all have very different time frames.
Right.
I don't want my emergency fund to be volatile.
Right.
I'm not sure when I'll need it.
Right.
I just want to make sure the money I put there stays there. But if I'm doing the same process in my retirement account, well, I'm never going to grow it enough to retire.
Right. That's a different fund. Right.
And that's why I say, like, it's not better or worse funds. They're specifically designed for different purposes.
That's valid, actually.
Right. So you're not always looking for the fund that has the highest return.
Maybe
it depends.
Maybe that's where the entrepreneurial guy comes out of me. Though it's like growth.
Yeah. But again, like, that's a lot of what I do with. I'm essentially a calculator user for my clients, right? They go, well, what if I got 9% over the next 3 years in my house saving fund instead of 3? And I go, well, that makes a $1,800 difference.
Right.
Is that $1,800 to you worth the potential of being $1,800 the other way?
Right.
And they go, well, no, I want to make sure it's all there.
Right.
Okay, then we're not.
This isn't the right thing for this particular goal.
This isn't the right vehicle for this goal.
Yeah.
Right. So
that makes a lot of sense, actually.
Where the advisor comes in is just helping you understand and pick the right vehicle, because there's endless options of vehicles.
Sure.
And even if you look institution to institution, it's the same thing. Right. They have 3, 5, 6, 7, 9% funds and options in between there, and they all have the same principles of investing, right? This is mostly stock market investing. We're buying companies. This is mostly we're buying fixed income products. Like something that I'm loaning my money to something, either a company or a government or to the bank itself.
Right.
and they're going to pay me a fixed rate of return.
Right.
Okay. And usually that's a fairly low return compared to the stock market. But this isn't going to...
Is that like a bond?
Yeah.
Like a bond?
So a bond is a corporate loan.
Yeah.
I'm giving my money to a company. So they have cash to spend, and they have said, well, we'll give you 4% back a year, and we'll pay this back in 5 years.
Gotcha.
That's what a bond is. So that type of investing is designed for the
Isn't there
short term.
government bonds though too?
Yeah, treasury bills.
Like okay.
Or they had like World War II bonds for our parents' age were huge.
Yeah.
The government needed a lot of money after the war.
Right.
So they issued bonds and said, hey, citizens, if you loan us your money right now, we'll pay you 5% and we'll give it back to you in 5 years. And that's how that vehicle is great because it doesn't introduce a lot of volatility.
Right.
Because it's a fixed rate of return. I mean, we could dive into the buying and selling of secondary bonds, but for the basics,
there's layers to it.
There's layers to it, but as an investor, that's deeper than what you need to understand. But yeah, it's fixed. It's never going to be a very high rate of return because if a company can go to the bank will say, "We'll give you that money for 4%."
Right.
They'll go, "Well, what if I issue a bond for 3.5?"
Right.
Then I can get that money cheaper. But I'm never going to, if the bank's going to give it to me for 4, I'm not going to issue a bond at 7.
Right.
And simple math.
That makes absolute sense.
So there's those types of investments that are good for short-term, low risk, low reward, but that's not the point. And then, or we can get in the stock market where things go up and down quite often, but companies are growing at a rapid rate, and we can get 8, 9, 10% over time. Yeah. But it's going to go up and down a lot.
Yeah, well, I think you said an example about was it the 2008? Just I think that's the closest thing
the housing crash.
Yeah. And I think you were mentioning was it around the S&P 500 or
something
like that?
That was the most effective. Like the U.S. market was most affected by that.
And basically like the people essentially thought it was end of days.
Yeah. You name something every 3-4 years that's the markets are crashing.
Yes, and then basically had you just stayed in it, you still would have kind of come 100%. Out ahead, right?
Yep.
If I remember your story correctly.
Oh yeah, like it only took 3-4 years after 2008 before the market was back to where it was previously.
Yeah.
And obviously that's a stressful 3-4 years if you're an investor.
Right.
But understanding like the market can't just collapse.
Yeah.
What that means is the S&P 500 is the 500 largest companies in the U.S. Just based on market share.
Yes.
Okay, so if all 500 of those go broke,
well, and
the whole economy's
and not to be controversial, but clearly the governments won't let it collapse.
They can't. Then the government ceases to exist. Like
the
whole system has to fail.
Like I think if anybody learned anything through even the U.S.
COVID or 2008
or any of that stuff, it's like they're not. Even automotive, right? Like the companies got saved, for lack of a better word, I guess. But
they get the bailout.
They got bailout funds. They weren't going to let the economy crash.
Yeah, and they
entirely.
No, like there's gonna
didn't mean that there wasn't some.
There's gonna be some shaky stuff, and and it's gonna be shaky in different sectors of the economy and in different countries at different times. But the stock market can't disappear.
Yeah.
Because all it is the companies around the world that are providing the products and services we use.
Yeah, it'd have to be an absolute apocalypse.
And we walk through this with clients, but just to try to reduce some of that fear.
Yeah.
If that happened, say just you bought the S&P and the U.S. market ceased to exist. Yes, all of your investment would be gone.
Yep.
Because all of the companies you own would be worth $0.
Yes.
It would not matter because your money that you could or could not have would be worthless if the economy didn't exist to use your money.
Yeah, even if there was an apocalypse, money would be irrelevant anyway.
Even if you stash it under your mattress, it's not going to be worth anything to spend.
You're going to use it as kindling.
Yeah, right. In World War II Germany, people were burning wheelbarrows of money to stay warm.
Yes,
because there was no economy to spend it.
Right.
That would be. So the fear that people have of I could lose all my money, if that happened, which it never has even come close to, it wouldn't matter. we'd be so far
Would
gone.
you say and I mean, even then you would have already been ahead. This is why I'm just trying to paint different scenarios so people really get it. But like, even if you were at the retirement, like literally about to retire when, the U.S. had its market crash.
Yeah.
And obviously there was a lot of losses. Mm-hmm. But if you were still doing that over time, like no matter what, you would have been ahead.
Yeah, and we run projections. It's kind of the nerdy number side, like just for fun, we say. They're fun to us. We're like, hey, what if you just reached your retirement goal and you retired in 2008? And then what would happen?
Yeah.
Over the next, like in actual market conditions, if you took out the monthly amount you had planned from the start.
Right.
And you would still have money when you're like 95. Because it's not like you hit retirement, you go, I've got $1 million to retire. I would like that all into my checking account.
Yes, that's
right.
I think that's the misconception, right? It's
Yeah,
like,
no,
well,
you take
I got
out
my $1 million. I want it all.
No, yeah, like you take out a few thousand a month, whatever you need to live on
Yeah.
or have you set up for your goals.
Yeah.
And the rest stays
Still
invested.
stays
So as
there.
the market comes back up,
Yeah.
well, 95% of your money is still growing in the market.
Yeah. Yeah.
So over your retirement time, what's left in there is still can grow as the
Yes.
market recovers.
Yes, and like you said, even in that situation, it was like 4 or 5 years that it recovered. Mm-hmm. It's not in the long term thing of things. Like, yeah, it's not a significant amount of time. It's not like we're talking about market crashes that are like 50 years.
No, like you look at the averages in the S&P, the average down market lasts 14 months.
I mean, yeah,
And
I was going to say,
is that a
what was
stressful?
the Great Depression? Do you know?
Oh,
Sorry,
no
that
idea
one's a
the
weird
exact numbers on that.
Yeah,
But
I'm just curious how long that era lasted.
even the one I do
I
know
don't
because
remember off the top of my head.
it's on the index chart we use is World War II.
Oh, okay.
And in the European markets,
Yeah.
in World War II, so having a world war on your home soil,
Yep.
it was about a 12-year window
Okay.
from where the market was to getting back to level.
Yep.
Was about 12 years. And that's obviously, in recorded history, that's the biggest. Longest drop.
Huh, okay. Okay, that's cool.
And there's been nothing anywhere close to that since that in any of the markets.
I mean, that's why I say, like, whether it's 2008, whether it's whatever, .com, whether it's COVID, like, there really hasn't, I mean, knock on wood, I guess, but there really hasn't been an event that has really lasted like a significant period.
No, and
in fact, it's lasted more the other way.
oh, much more. Like there's on average 4 good years for 1 bad year
Right.
in the S&P. So,
Right.
and that's where if you have the time, like the 1 bad year at the wrong time, if I'm saving for a house, that's a problem.
Yeah.
But if I have the time
Yeah.
to just ride out the bad year, stick to the plan,
Yeah.
well, on average, there's 3 to 4 good years to follow,
Yes.
right? So one of the analogies we use in some of our presentations is if you went to the casino and you had a 75% chance of winning.
Yes.
You rolled the first one, you lost. Do you go home or do you roll again? You just understand the odds, right?
Yeah.
I roll again.
Yeah, I roll again.
Even if I lose 2 in a row, I roll again because I have a higher chance of winning than losing. That's the stock market.
Actually, it's funny you say that. I used to say that about, well, not used to, but I don't say it that often anymore just for whatever reason. But I used to explain Google Ads that way.
Oh, yeah?
Yeah, I always said, okay, so, because I guess what's different about our industries is like you're trying to create a long-term plan goal. A lot of times people with marketing
They want it now.
like the instant, right?
Yeah.
But I always used to say, like, imagine if we went to the casino and went play blackjack, and you put down $20, and every hand you got your money back plus another $20, how long are you sitting at the table for?
Till they kick me out.
Yeah. And so I always kind of explain, like, you have to understand the number, but that's basically how lead generation works.
Yeah, and it's the same.
You're going to
concept,
get your money plus
a little more.
a little more. So if you just invest in it, like, you're going to keep getting that return.
Yes.
So yeah, I feel like investing is just more on the long-term side, but similar, right?
It definitely is, right? Because it's long time frames. Like even on the average, a a 14-month down.
Yeah.
Well, you got to sit there for a year and 2 months as an investor and watch tick, 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 down, down, and it's your money.
Yep.
So there's emotions involved.
Oh, sure.
Right, and that's where the role of the advisor becomes important. It's so easy to be an advisor when the markets are good.
Right.
Your job, you really get to work as an advisor when the markets aren't good.
Right.
And I started my career just before COVID.
But not everything is going to be down. It would be almost impossible.
No, I mean, like during COVID, it was pretty hard to find anything that was going up. Other
True.
than toilet paper.
But right. But I feel like there was like, I mean, I know even talking to like some local style businesses, like, well, yeah, I don't want to say the name, I guess, because in case they don't want, to be a part of the conversation.
The free plug.
but no, like there's a manufacturing company here, and you know, and they were producing some metal stuff, and like I remember they're like, we're now booked, like we have jobs booked for the next 3 years.
Yeah, and it doesn't take.
And I remember
long.
They even said to me, like, we have a multi-million-dollar order that someone contacted us, and they're like, yeah, like we'll pay extra. We just need it. And
We
they're
just
like,
need to get
and
it.
they're like, no, like no.
Just pay the normal price.
Yeah, like here's the price, and it's still going to be a 3-year wait.
Yeah.
And I remember hearing stuff like that. Again, not on every front, right? But like there was industries that were like.
And you
exploding,
see it,
and there was a lot of industries that were not.
But it's like the market always changes.
Yes.
Like what types of companies are doing, and like you saw it using the U.S. the S&P again, right?
Yep.
Like COVID caused a big pause.
Yes.
Well, pausing the economy, obviously the markets drop.
Sure.
And then it just looks for.
But it was an unknown pause. Is really all it was.
It's just like we don't know what's gonna happen.
Yeah.
And then once a few things got sorted.
Yeah.
Then all of a sudden, yeah, we can jump on companies like Zoom. We can jump on companies like Alphabet.
Right.
Right, that start to produce.
Yep.
Now all of a sudden, in this new look, over the short term, these are the companies that are producing.
Yes.
Right, so there's always.
If you were invested in theme parks and movie theaters.
And malls.
Yeah, like it was going to be a hit for a bit. But even you look at those.
Yeah.
They've pretty well all come.
If you held them over 3 years, you're probably still fine.
Yeah, like you're probably still ahead.
Everyone wants to get back out again.
Well, because this is actually, let's talk about that, because that's the part that people also forget about, is if you're, at least that I understood recently, was, well, that's also an opportunity. Mm-hmm. Like, if you're looking at it from the long period of things, like if you're investing continuously, and maybe I'll use, because I remember paying attention to it,
I'm glad.
but like Cineplex, right? Like if you invested in Cineplex over time, like it was absolutely fine
until COVID
investment. COVID hits, boom,
yeah,
like absolutely jumped off a cliff because whatever.
You can't go.
And again, not to go into every single intricacy of that story, but like if your investment, if you kept making your monthly contribution, you were now still picking up shares
for cheap
at a basement bargain price. And that amount is also going to now increase as the market
right now you have more shares growing.
I'm not saying that the company couldn't have gone bankrupt, but
yes,
in this, but that's just one company.
Right, and if you take that into a macro scale, right, where you're in a fund that owns 100 companies with a manager selecting them.
Yep.
What you're doing is you're buying shares of the fund.
Yeah.
So if that fund, because of COVID or whatever, as a whole is dropping in value, the shares of the fund are getting cheaper. Right. So if you're buying every month, well, this month my $200 actually bought me 10 shares instead of 8.
Right.
The last month it only bought me 8.
Right.
Right. So yeah, and it's pretty simple, but again, it's when emotions get involved, it's not simple.
Yeah.
But to think like, what is like the first thing you know about investing? When do you want to buy?
Now.
Yeah, that's actually an even better answer than I expected. But do you want to buy high or low?
Okay, well,
you buy low,
you buy
sell
low,
high.
you buy, yeah.
So, but when the prices go low, what's the first thing most people want to do? Sell.
Yeah.
And it's so they end up selling low and buying high, and then they go, the markets don't work.
Yeah.
Well, no. realistically, the study of finance in the client-facing side, the advisor side,
Yep.
like obviously the study of finance for the fund manager is a different animal than
Yeah.
the study.
Oh, yeah.
But for us, like the study of finance is pretty well just how do people behave with their money. It's not as much of like the back end of earnings reports and
Yeah.
price to earning ratio and Sharpe ratio. It's how do we behave with our money.
Yes.
And if we can behave reasonably with our money, which a good knowledge and understanding base helps that,
Yep.
it's inevitable we have success, right? Just do the math.
Yes. Yeah. What about okay? I'm kind of switching gears a little bit. What
Okay.
about corporations? I want to talk about that. Maybe it's
about
not
them?
your total area of strength, but
Yeah, we'll see if I can help.
But we've talked lots about like individually someone growing, their portfolio for retirement or for other
For whatever.
savings and whatnot. What about for businesses? Like, can businesses invest?
Yes.
And again, I'm the ignorant one. I preface this, so I may be asking a question incorrectly, but like, I guess a couple of things. What would be the purpose / benefit of a corporation investing, if you have an answer to that at all? And I guess just does it make sense?
Yeah, it's very circumstantial, right?
Yes.
Like, obviously, if you're holding money in your corporation
Yep.
that you have no intent to use, it's just staying in there so I don't have to pay taxes on it
Yep.
today. Yes, you can open a corporate investing account,
Okay.
and as long as all the shareholders sign and yada yada, it's a little bit more of a process,
Yeah,
obviously.
yeah.
But yeah, you can take that money and invest. You don't get any tax sheltering,
Sure.
obviously.
Yeah, yeah.
So the taxes are a bit different, and that side of it is your accountant.
Yeah.
That where you need to have that
Yes, of course.
discussion. But yes, the simple answer is yes.
Outside of the tax component of it, I just meant like,
Outside, if you don't want to claim it as income and you don't have any reason to use it in the corporation,
yeah,
and you want to grow it in the meantime, yes.
yeah, that makes sense.
Now,
Yeah, because not everything is about having to buy equipment today or whatever, right? Like, I imagine there's some businesses that do want to find a way to generate a, 10% rate of return on the money.
see, and like, yeah, a lot of that, like in a corporation, I would probably say this is fair for 99.9% of circumstances.
Yep.
You're not investing your corporate money for your retirement.
Right.
Like, this is not a long-term,
No.
I'm going to go in volatility and I'm going to try to get a high rate of return over the next 30
Could
years.
be a hedge though.
It could be, or a lot of it is, I don't plan to use this money at least for the next year or two.
Yeah,
I'd like to make 3% on it
You're right.
instead of it doing nothing.
right.
Yeah,
Yeah.
that's a lot of the corporate side of it is like, and sometimes that's very beneficial because it could be a large chunk of money. And
Right.
3% is a
Yeah,
fair,
it's
a fair amount.
yeah. A lot of times now it's not personal finances. It's
Right.
It's a corporation finance, which, I always said like people. I always kind of tell a story about somebody I had that worked for me at one time, and he struggled in sales, and the reason he struggled was because he looked at what he was selling as, would I buy this with my own money as a person?
But he wasn't
Right.
selling it to people,
No,
selling it to businesses.
right. But his mind
Yeah.
was like, this is my income. Can I afford to buy this? Not whether the product was good for the client or whatever, right? It was just about
Yeah.
simply like money math, right? And it's like, well, whatever the number was, but it's like, I wouldn't be able to afford to spend $1,000 a month to do this, so other people won't.
But the corporation could.
And that's why I say it was a different component, because it was like, well, your $100, again, obviously I'm just making stuff up right
Yeah.
now, like it could be substantially more, but your $100 a month is that corporation's 1,000 or more a month. Like,
And you have to think if they don't spend it,
yeah,
it's a tax burden.
yeah,
And if they can spend it on something that generates more business,
yeah.
like, yeah.
So that was kind of, and it was funny. It took him a while, but once it clicked, he was like, "Oh, yeah, okay, yeah, like it's way different." It was like, yeah,
Yeah, this is not the personal.
They're not looking at it from the
budget game.
$100 a month perspective. I mean, if it's a benefit to their business, like
Right.
whatever the number is, if there's some like ROI component to it, it makes sense.
Exactly, right? And that's where even some of the corporate investing, it gets much more complicated, which I enjoy.
Yeah.
But then, the accountant gets involved and the bookkeeper gets involved, and because we have a lot of options of what to do with that money.
Right.
Right? We can invest it into new equipment. Well, does that speed up productivity and increase performance and then profitability? And is that profitability more or less than what? Do I want to grow the company?
Right.
Is that something I want to do, is go, get more equipment and more people?
Right.
Or do I want to stay this size?
Right.
Right. So there's a lot of those variables, and you just have, I guess there's just more options.
Yeah.
If you're a corporation, on do I invest it back in the company? Do I just invest it for the time being and wait for?
I just wasn't sure if like businesses hedged the money, like, and again, total ignorance. I don't know anything about it, but I was like, oh well, let's just say you go and I don't know, just to keep math simple, you take a loan out for $100,000 and you're paying 5%. You've got cash in the bank though. Like, I just mean like not that money, but like you're growing the business, there's cash in the bank, you're just making your payments, you're not planning on paying it off in a lump sum. It's like, well, what if all of a sudden you've got, $500,000 or whatever the number is?
Yeah.
It's like, well, if I don't need it and I invest it, am I hedging against my 5% that it's making the payment for? Or...
Which is like, pretty simple math. Are you going to make more than you're paying or not?
Well, I've heard that in personal, like, don't get me wrong, I love watching business TikToks and podcasts. So like I've seen that a lot in terms of like personal, not corporate, but personal, like when a lot of people talk about like, oh, like you want that fancy car, for example. And it's like, yeah, like don't go buy that car cash until you've got your investment vehicle making the monthly payment for you.
Right.
And so on and so on. And I get that can be a hefty amount at the end of the day, but again, that's like in the ultra rich world, obviously.
Well, even like the numbers just get smaller, but the principles stay the same. Like,
I guess that's true.
If
whether you want a Toyota Corolla or
Lambo.
like
it just might be like instead of looking at buying the Rolls Royce cash, you're looking at buying the Honda Civic. Right, like the numbers are just smaller, but it's the same principle. Like, obviously, debt. And interest rate plays a lot into this, right? Like when interest rates were low, sure, like you're paying 2% on your loan.
Yeah.
Can you make more than 2%
in the market?
Well, whether in the market or investing back in the company or probably. Yeah. Well, now money at 6%.
Right.
Now those numbers get a little tighter.
Yep.
Right. And like the problem in the investing world with leveraged investing is you're adding more risk.
Gotcha.
Right. Because if the markets don't perform in the way I want them to, now the money I have on loan is losing money, and I'm paying interest on this end.
Right.
Now I'm doubling down the wrong way.
So, assuming you're doing leveraged investing, is that where like companies that have like dividends come into play, or is that what you're looking for? Or again, totally ignorant question.
Okay, so let's go.
Like why would you leverage? I guess maybe is the better.
I don't know.
Like only if like in like what you just said earlier, would you borrow to invest simply if interest rates were low? Like what you said, if I can get a loan for 1.5%,
that would make the most mathematical sense. I still wouldn't recommend.
Right.
Don't.
Because either way, you have a monthly payment.
Yes. And so, okay, twofold. We're going to get to like what a dividend is.
Yes.
But first, so if we think interest rates are low.
Yep.
Okay. That means if I want something stable, like a bond or a treasury bill, those are also low.
Right.
Because they're in the same interest rate environment.
So
right? Because now I'm borrowing for 1.5%, 2%. Well, the company that went to the bank told them 2%.
Right.
And now they're giving a bond at 1.5.
Yeah.
Right? So it's not like, I can get a bond at 6, well, I get a loan at 1.5.
Right.
No, those are tied together. Everyone's getting the same interest rate environment.
If you do that, then you're really just trying to target the higher your risk.
So then you're taking, sure, if you can get cheap money, but to beat it, you're going to have to take on some risk because the interest rate environment's the same.
Right.
So now if I want to beat it, well, I have to get some money in the market.
Right.
And yeah,
Anything
if
good?
you want to tell me you know whether it's going up or down, then you have my job in a crystal ball because you'll be really good at it. No one knows. Like we can make our guesses short term, but again, COVID.
Yeah.
So you have a leveraged loan now, and oh great, I made 6% and I owe 1.5,
Yeah.
and COVID happens.
Yeah.
Now you're getting screwed on both ends.
Yeah. Yeah. And now interest rates have gone up and and you yeah.
And so it just like really muddies the water, and there's very, very, very few situations where it's at all necessary, if any.
Gotcha. So going back to dividends, though.
Back to, you asked about like, would then I want to invest in dividends?
Yeah.
So,
I always heard like Kevin, man, don't get me wrong, and not everybody likes Kevin O'Leary of all people, but I always appreciated watching Dragon's Den and Shark Tank.
He's smart.
And I read one of his books, and again, whether he's bullshitting at this point about it, but I thought I read something that said like, I don't invest in anything that doesn't pay me a dividend.
So
what's something
a
he said.
dividend?
Yeah. So it's a percentage of earnings on a share? Is that kind of the right way to?
Not even percentage of earnings, just percentage of the total amount.
Total share.
So if I have $100 in a company that pays a 5% dividend, and if it's an annual dividend, they give me $5 a year.
Right.
Okay, and what a dividend is a share of the company's profit.
Right.
So if I'm a large company and I make a bunch of money, I've got a few options. I can claim it as income and pay corporate tax on it.
Yep.
I can reinvest it into my company.
Right.
Now I don't pay tax on that because I've spent it.
Yep.
Or I can give it to my shareholders as a dividend. They pay the tax on it.
Right.
And I can increase confidence in my company and my share.
Right.
So that's what, if I'm a large company, Walmart is a very famous one for dividends. If I'm a large company like Walmart and I'm not really actively growing that much, so I don't have stuff to spend my money on, I give it to my shareholders so that more people want to buy my stock. It boosts the value of my company and it increases confidence in my stock.
Right. I've seen that in some others, like Suncor.
There's a lot of
like
large companies that pay dividends.
Yeah.
So he says, I want to buy a company that pays dividends. So what you get then is your, I'm not going to dive that deep.
Yeah.
But so what you get then is like, if Walmart continues to grow in its price, you get to participate in that growth as an owner.
Yes.
Plus, you get to have the dividend on top of that.
Right.
So that's nice. That being said, a company like Walmart, who isn't actively expanding, likely won't grow at a rate as like Tesla.
Sure.
Who's putting a lot of money back into development and they're growing fast. Right. So those companies who are younger generally don't pay a dividend because they're reinvesting it all.
Okay.
The older, very large, stable companies, they're paying a dividend because they don't really have a lot to reinvest it on.
Yeah.
But the young companies have more growth opportunity. The Walmarts probably aren't growing at a very high rate, right? So that's kind of the play between the two. And where I wasn't going to go super deep is the Walmart side of things is generally known as like value-based investing.
Gotcha.
You're buying, you're trying to buy it at a good price.
Yep.
You're not expecting a ton of growth, but you want to get some value for the share price you bought.
Gotcha.
Okay, where growth style versus value style is, I'm not overly concerned what the price is today. I'm expecting this company to grow a lot in the future. So I'm just buying it and hopefully it grows.
Right.
So that's growth-based over time, has potential for higher returns, a little more risky when you're in the market to do all growth-based. And then there's the value-based where we're just going to try to find Walmart on a time when it's a good price. We're going to buy it. It'll grow a bit. That's great. We're going to try to get in for cheap, get their dividend. And
so even though this is probably the boring word, this is really where, I guess, diversification is really like at play in all of
100%,
someone's investment. I keep wanting not to say portfolio because I don't know if everybody understands what that means, but
Right, so like if you own 100 companies,
yeah.
I mean, it's up to you. There's certain companies that really focus on growth. There's certain investment companies that really focus on value and do really well in those spaces. But yeah, owning 100 young growth companies, it's up to you. But like that holds a little more
risk.
That's going to go up and down more versus like well, I want mostly growth, so let's find a fund that is a bit of both.
Right.
Has some growth investing, has some value.
Yeah.
It's all in the market, but even investing in the market, we can diversify
Right.
greatly in the types of companies we're buying, not only, where we're buying them, in what countries and in what
Right.
sectors of the economy, but also in the types of companies,
Yes. Yeah.
right? And
That
this
makes
is
sense.
like probably a layer deeper than, the standard consumer.
Yeah.
But again, hopefully that gives a little bit more understanding of, the fear of the market,
Right. Right.
So
Yeah.
that's where someone like Kevin, he says, I want the dividend. Well, he's got millions of dollars.
Yeah.
If he gets a 5% dividend on his 10 million,
Yeah.
he's laughing,
Yeah. That's a great, yeah.
right? 5%.
On top of the fact that he didn't have to touch the money.
Right.
Right.
Right, like it's nice.
The money's still in the company, plus he got that value based.
Mm-hmm.
Yeah,
And
yeah.
for like Joe Public, what happens is if you own companies that pay a dividend,
Yeah.
it just automatically reinvests and buys you more shares
Yeah.
of the fund.
Yeah.
Right? So it's not really a complicated thing that you ever have to worry about.
Yep.
But yeah, that is kind of the difference between growth and value. And a lot of the value side is very dividend based.
So obviously everybody has different goals. I totally understand that. I'm not trying to paint like a broad picture,
Yeah.
just trying to make it as clear for, Joe Public as possible, I guess.
Yeah.
But is there, I imagine it would be age specific to boot, so maybe this is a ridiculous question, but is there generally like let's call it a pie of percentage based investing? Like, hey, like I want to have 20% in that startup, I want to have 50% in the S&P 500, and I want to have the rest in a bond or whatnot.
There's no like where to become financially
Okay.
independent.
Okay.
It's not like, hey, this investment is the one and this is the exact layout.
Yeah.
It's person specific.
Right.
Maybe I'm someone who likes a little more risk and I got time and let's buy a fund that invests in, the small and mid cap, the smaller companies.
Yep.
Instead of, large companies that are stable.
Yep.
And that's person to person based. And again,
Yeah.
I'm going to sound like a broken record. What it comes down to is understanding the differences and making an informed decision for yourself.
Yes.
And then understanding kind of what to expect.
I imagine
your
because also there's such an array of, obviously there's an array of companies
Yeah.
yeah.
Like you buy the S&P 500, you can own 500 companies in
Yes.
a second and a half.
But I mean like you're talking like individual stock bases, like I mean, gosh, the sky's the limit, right?
Right.
Like,
And that's why
so it's I get now it's impossible to say like this is your
It is.
your safe not maybe safe, but just like a standard percentage pie of
and
investing.
there's no like percentage pie. And again, like if you want kind of as close of an outline as I'm willing to give,
Yeah.
would be a retirement fund
Right.
in the stock market.
Yep.
So we're not buying bonds, we're not buying treasury bills,
Yep.
we're not buying GICs.
Yep.
We're in the stock market.
Yep.
And then a midterm fund,
Yep.
depending on time frame, a mix of both.
Gotcha.
50-50, 60-40, 70-30,
Yep.
stocks and bonds,
Yep.
whatever,
Yep.
depending if it's a 3-year or a 10-year midterm fund.
Yep.
And then an emergency account.
Right.
And we can even use something just like a high interest savings or
Right.
a very low volatility bond fund.
Right.
And so if you want a pie, I mean, that's 30%, 30%,
Yeah.
30%.
Yeah.
Set it up. But those are kind of like as close as I would be willing to get as a copy paste for people is those three funds. And
Gotcha.
then, all stocks, a mix, and a bond, and for 3 different purposes.
Yes. Yeah, and again, that makes more sense. I wasn't trying to
Yeah.
corner you into a number.
Yeah. Tell me which fund to invest
Yeah,
in.
no. I like I said, even asking the question, I'm like, well, that really does depend on.
It's very, right?
It's just so dependent
like-
on someone's risk tolerance, and I hate that word, but like,
And
yeah.
I mean,
it's not even about risk tolerance.
I much prefer to say volatility tolerance
Sure.
because risk is time,
Yes.
right? So like the S&P is risky over a year, the S&P is not risky over 40.
No, but
So
I'm
like
just,
that's why like how comfortable are you with volatility?
yeah. The only reason I said risk tolerance is like, yeah, like if today a new company came out on, I don't know, doing water as fuel, right?
Yeah.
Hydrogen fuel or whatever, like it's anyone's guess which way that is going to go.
And that is
And
why
you could put money into that single company,
you could.
and they could go bankrupt or whatever.
See, and this is
so
why-
there are areas where there are some risk tolerances, but not if you are doing a lot of fund.
No, and I was going to
purchasing.
say that's why I advocate for most people, unless you're highly educated and you want to be very involved in this,
Yeah.
because it's an everyday thing if you want to buy and sell your own companies,
Right.
if you want to be somewhat successful.
Yeah.
Just hire a professional to do that for you. Because then they're going to go look at this water fuel company and they're going to say, well, what's your price to earnings ratio? What's your profit and loss?
Right.
What do your books look like? And I would assume that's a much more informed decision than you're going to make.
Right. Yes.
Right?
100%.
And then they're going to also balance that with what other 80 companies do we own? And does this kind of fit well with the overall picture?
Gotcha.
And as a consumer, what you get to choose is what framework do I want my professional to work in? So for a retirement fund,
Yep.
I've chosen I would like the framework to be you're going to only buy companies. I don't want you to buy bonds or anything.
Yep.
And I want you to buy companies all around the world. So I'm not going to limit you to one country,
Okay.
right? And I want you to buy growth-based companies.
Oh.
And now that, right, and they have, from their selection of funds, you can go like, I like this framework,
Right.
right? And then you go, this is where I want to put my money, or this one, this one, this one.
Yeah.
These are the frameworks I want to use. And the manager's job is to then, within that framework, find companies that he thinks are going to do well.
Right.
So if I've said, hey, this is my retirement fund, but I want, all large cap, all big companies all around the world, and this water fuel company comes up,
Right.
that's not in the framework.
Right.
I didn't say you could go buy little companies.
Gotcha.
There's a different framework that water company might
Yeah.
be in, but that's not part of my portfolio.
Yeah.
So that manager's not going to go do it because his job is to work in the framework of that fund,
Yes.
which I have chosen
Yes.
as a consumer.
That's actually okay. So that's actually a really great way of explaining it, and that makes a lot of
Right, and so as a consumer,
sense.
like all you have to understand to have a really good idea of your financial picture is what do those different frameworks mean,
Yes.
and why are there different frameworks,
Yes.
which we talked about with
Yes.
bonds and stocks.
Yeah.
Right, and that's all the frameworks are.
But you actually, that was really well explained because I feel like that's kind of like, again, using the water fuel company as the example, right? There's the potential for an upswing, and you might get a great rate of return on it. You might not. A little less safe, for lack of a better word,
Yeah.
but you can invest in Coca-Cola.
Yeah.
You're not going to get nearly as
There's not as
much
much
of a
growth.
potential upswing, but it's stable. Likely not going anywhere, right? It's going to be a lot more of a soft.
Yeah,
And
there's
so
a dividend there.
but again, now that makes sense. Like if you're a money manager or fund manager that operates within the S&P 500, which generally the best companies in the world,
yeah.
they're not looking for
No, that's
Joe Schmo, even though they just created the coolest, greatest new technology, that they're
Right.
not part of that
not
space.
there might be a different manager that is the U.S. small and mid cap
Right,
manager.
right.
He's looking for that.
Yeah.
But if I, as an investor, don't want to be exposed to that framework,
Yeah.
then I don't pick it.
No, but I just
You know
meant
what I
like
mean?
that's that.
Yeah.
I can now understand. It was really well explained. Like that fund manager isn't getting distracted by in this particular space in this particular framework by that shiny toy.
No, that's not within his scope.
There's
right?
other fund managers that are looking
Right,
for
and
that
when-
shiny toy, the possible next unicorn.
And that's that's the fund, and whether you choose it or not,
Yeah.
like the base idea would be you have enough understanding
Yeah.
about how these framework works
Yeah.
to say, do I want that one in
Yeah.
my portfolio or do I not?
Yeah.
And why would be it. It'd be
That's
nice
awesome.
if you could explain a bit of,
Yeah.
I think that one offers a little too much volatility and I'm not quite comfortable
Yep.
with that. Great. You've made an informed choice and you understand why you've made it.
Yep.
And you understand how that affects your overall picture.
Yes.
Right?
No, that honestly, these have all been like really, I feel, good explanations, and I hope
Good, I'm glad.
I hope I asked questions
I usually have
somewhat
like,
informed, and then a
yeah.
lot not informed, just
No,
so
they were
that
good.
we could like figure out some of the
well, you brought up most of the common topics that,
yes.
that come up in these, and usually I have a screen and pictures and
Yeah.
other ways to explain it other than
Yeah,
just
now
me
I put
rambling
you in the
on.
hot seat. Now
So
it's like,
this one
say it without your charts, mister.
really good for me without being the laser pointer, and you see here, to have to just explain it
Try
has
this.
has been good for my brain too, honestly.
Try this.
new challenge
Yeah,
accepted.
3 in the deep end. It's like swim.
Yeah.
You get nothing to show today.
No, you get your mouth and your silly hand gestures.
Yeah, I was gonna say I should have had one of my team members just come and hold
Yeah,
hold
and
cards
as
that
you
you could.
see here.
Yeah, and as you see here, this is how this works.
Yeah.
Maybe we can do it with a picture
Yeah.
in picture.
Someone put a little screen in here with a couple
picture in
slides.
picture with a couple of slides showing the growth.
Yeah.
Awesome. Well, thanks, Daniel, for your time, man.
Yeah.
I really
thanks, man.
appreciate it. I hope people got
Glad I made
educated.
it.
So
I hope so.
it was awesome.
At least a little bit.
A little bit, yes,
Yeah.
a little bit.